growth in the green area. SSSG, same-store sales growth, will be green. SSSTG will be green. You will find that revenues will be in the green. Gross margins will be in the green. Restaurant level profitability will be in the green. Company level profitability will be in the green. So, the strength of brands and companies is visible in tough times. Now, you're aware that the market has kind of slowed down a little bit in the last few quarters. And in this environment, RBA continues to deliver positive same-store sales growth. In fact, if you look at the last 9 quarters, we have continuously reported positive same-store sales growth. So let me first take you through the 10 years that we have been as a brand, what we have done. It's a very auspicious year for us, completing the 10th year. So I just wanted to kind of walk you through the brand it has been and the brand it is going to be in the future. So initially, as you remember, we had established this in 2014 by building a menu that was, Sandeep Dey, our president in Indonesia, says familiar discovery, which is build a brand that was Western but taste of India, right? Very, very Indian taste in nature. A brand that had menu items which were very strong in the veg focus areas. Veg value variety. I think you heard Kapil say this in the initial years of our brand, that we build the menu on veg value and variety. So we did that. We did the largest taste test ever done in India on food, which was over 3,000 people that we tested. We built the products around that. And then we launched the brand with Whopper in focus, which is our flagship burger. Now, we continued that by bringing in a value strategy, which is, fulcrum for the Burger King brand across the world, that we believe in driving, trials and getting people into our brand, into our business from the value sector. So we did 2 for 50, which is graduated today. Last year you saw us do a 99 rupees meal, and this year you have seen us do 2 for 79. So those strategy and value continues to be strong. It's a 10-year-old strategy. It will continue to build. It will continue to evolve as we move into the future. We also then started building restaurant footprints, creating awareness, marketing, advertisement, all these things create awareness, but also building restaurants create awareness. So we have built, 456 restaurants as we stand today in 107 cities. In addition to that, we have built 351 cafes inside of these restaurants. So, which has been a ramp up in less than 2 years, actually slightly over 2 years, because we started in FY22. Now we are going into FY24, and we are literally, 351 cafes. There's about 100 restaurants that don't have cafes, which will start now getting cafes. All the new restaurants are opening with cafes. So a very strong menu strategy graduated into a very good value strategy, build a strong footprints, added day part menu or specifically by building cafes. And then we are graduating now as we move forward into the digital era, where we are now establishing SOKs, as we say, self-ordering kiosks in all our restaurants. So we have completed close to around 180 restaurants that are already running with self-ordering kiosk, and we will continue to do that. By the end of this year, fiscal year, we should be at 100% of SOKs as well. So in March of 22, we acquired the business in Indonesia, which is Burger King, and then we further on started to build Popeyes there. In August 22, we built our first Popeyes. Sandeep will kind of bring focus on our results and how we're moving forward in Popeyes and Burger King in Indonesia and all the challenges, the geopolitical, challenges over there and so forth. So that's basically, the last 10 years in India and RBA as we graduated into the Indonesian market. Last quarter, I told you the focus areas which haven't changed, which continue to be the focus areas for this company as we move into the next few quarters. One is to continue driving value. You've seen and you'll see, the value promotion that Kapil will be launching and has worked with in the last few quarters. So he will kind of bring that to life in his piece. But 2 for 79 and 2 for 99 has been on our communication now for several quarters and is doing very well. We also went into new occasions, not only with cafe, but launching the BK Pizza Puff, which is doing very well, which also addresses our snacking location and occasions. And in addition to that, in the past we have launched, nuggets, we have launched wraps. So there's a lot of new items, innovation that Kapil keeps bringing into the business, and he will address that as he speaks. But basically to kind of build and grow traffic. So our focus moving forward, continuing to bring in traffic. So this 9 quarters that I told you that we were positive same-store sales, we were also positive same-store traffic. So it is important to bring SSSG with traffic. And we continue to build on that and growing traffic, which has been predominantly a focus for the last 10 years, will continue to be a focus for the next 10 years. Digital brand, a brand that is accessible digitally, not only in front of the counter where the guests are, but also behind the counter where Cicely Thomas, and she will speak more next time when we do the next quarter meeting about how she is taking the brand digitally inside the kitchen as well, making sure that all our processes and systems are digitally to bring efficiency, number one, and also to reduce the number of mistakes that we can make on delivery of our orders. So that will continue as well. The last piece, which is the most important piece that we took upon a few quarters ago, is to have a laser focus on profitability. Now, one of the biggest attributes or inputs to good margins at the restaurant level is sales. And we will continue to drive traffic and sales, but also to manage our line items so that we continue to deliver a solid restaurant level profitability. That focus has been now split into 2 pieces. One is to focus on dine-in, which we have continuously spoken about in the last few quarters, which is continue laser focus on delivering restaurant dine-in profits. But in the last quarter, we have also started this journey of increasing our profitability at the delivery business. So you will see and you will hear more and more as we move forward to bring the margins on our delivery business higher and higher, and we will continue that focus as we move forward. So that's on India, and then Sumit will kind of share the results on all the items on India as we move forward. Now Indonesia. So Indonesia, we kind of went into this business in 2022, and since taking this over in March of 2022 and launching Popeyes in August 22, what we have done and where we as a brand over there. So initially, as I've said in the past, we took over the business and we went back to basics, which is what we do as a company. Again, went back to menu. The menu was not up to our snuff. It was not up to the market standards. We got the menu up. Every single burger, every single item, every entree was measured and tested and reevaluated and built up with new sauces and new patties and new toppings. So we did that. And Sandeep built a fantastic menu for Popeyes as well, at the same time fixing the Burger King menu over there. So we did that. We also then went into doing the menu architecture for both the brands. So there was a value, core, and a premium layer that was established. So all this work was done, And then we started a journey to actually, establish and start moving sales in the right direction, which we, as you can see in slide number 6, that, the red line is the current year, and you'll see that we had moved the sales significantly higher than the previous year, and we were well on our way until this geopolitical headwind started in late October. And this is a big challenge for the Indonesian market, for all QSR, that they're American, brands. They all suffered from retail down to food, down to cafes. Everyone got the hit on that, and we were no different. We saw that the line that was way above the green line suddenly dipped below the green line. Now, we then took the next couple of months to reestablish, start our business growth in our delivery business, and we did an effective job of that. As we climbed from January onwards, between November to January, to reach back the previous year's sales, and we did that very effectively. And then in May we had another challenge when there was a second bombing in Gaza, and there was another geopolitical wind that kind of took a toll on all the businesses there. So we have had challenges. We have set the business right. We have set the menu right. We have rationalized the restaurants. We have closed about 26 restaurants that were non-profitable, which are in the low areas or areas with no growth. We have cleaned that out. We also did the same with our overheads. We brought it down. We rationalized our total G&A count. We brought it down by 25%. So we have a very effective machine now in Indonesia, a very effective, team, very effective assets that are ready to grow and, become all they can as these geopolitical winds kind of go behind us. I think the reflection of the community there, the business community, is that post-October, there's going to be a uptick of this traffic back into the business. So we are hoping that is true, and we are working towards that, getting the business ready to kind of deliver on those numbers. So that's basically the Indonesia, and Sandeep will speak a little more about it, and you will get a flavor of where we are in terms of numbers and so forth. With that said, I will turn it over to Sumit so that he can carry you into this green page of all green numbers. Over to you, Sumit.
Thank you, Raj. I'll kind of use slide number 10 to take you through the overall performance that we have for the quarter. It also reflects some of the positive trends that we've seen, what Raj was talking about, as we go through these numbers. Firstly, talking about growth, obviously growth has been one of our key drivers. In the current quarter, we opened one store. It's not that we've really kind of gone back in any manner. It's just that it is by design. We had opened a fairly large number of stores, almost close to 40 stores towards last quarter of the calendar year. We're just kind of allowing some time for those stores to settle down. Our target to get to 510 by end of financial year is on track. Currently, as we speak, almost close to around 19 odd stores are under construction. So we're kind of now phasing it out over the balance part of the period, making sure that we get to 510 being the target. As Raj mentioned, our focus is driving traffic and then driving SSSG through that route of driving traffic. We're really happy to announce that we've been positive. While you are seeing here last 5 quarters, but we are really positive in SSSG over last 9 quarters. And this to be positive in a market scenario which is challenging. At the same time, being positive as we are adding reasonable amount of stores to the portfolio. Literally, we've been adding close to around 80 stores on an annual basis. We feel really we've been able to kind of manage the growth, balance the growth and the same store sales growth really in a balanced manner without really focusing the balance on the focus on either of the side. Having said that, effectively our revenues for the quarter, which was just a little shy, 10 crores shy of 500 crores, achieved 490 crores of revenue, 16% sales growth on a year-on-year basis. Slightly favored by way of a higher delivery mix, moving from 39% to 42%, which we believe that this is a broad range. Around 38 to 40% is the kind of range that it will remain as we go along, as we continue to focus on bringing more traffic into our dining part of the business. If we really look at it from the perspective of gross profit, we've always been focused in improving our overall profitability through focus on gross profit through various initiatives on the supply chain side. Over last 1 year, we've been able to improve our margins by almost close to 1.2%. As far as this current quarter is concerned, we are flat at 67.6% as we had reported last quarter. We must assure you that this is not a break in the journey to go to 69% that we've said we will achieve, which is that in the current quarter, we really wanted to aggressively pursue growth through traffic, and that's why it's a conscious call to remain at these levels of margins. And then now, Raj mentioned about that we will very strongly focus on the delivery side of profitability. So we will see the journey coming back as we go along the later part of the year, taking us to 69% target that we've spoken earlier. As far as overall profitability is concerned, we achieved 8.9% store level EBITDA and a 3.6% company level EBITDA, growing to 43.5 crores in the current quarter at a restaurant level. If you look at it from the company perspective, we grew to 17.5 crores from roughly 10 crores that we got year-on-year, or if we look at it sequentially, it's almost close to 70% growth in EBITDA. We did see some challenges with respect to the cost lines. It was more because of the external environment of the seasonality side. Extreme heat did impact us on the utility side, which is why we see some of the translation on gross profits didn't materialize as far as restaurant EBITDA is concerned. And a slight shift in delivery mix from 39% to 42%. So the translation gain or the improvement that we saw on gross profit, we did lose a little bit of that on the restaurant EBITDA side. We've always been talking about getting the leverage benefit as we grow on the G&A side. In the current quarter, as we've grown revenue by almost close to 68 crores, the corporate G&A has reduced as a percentage of revenue by almost close to 4.3%. So that's the journey that we will continue to see as we go along going forward. So that's the India business part of the journey. Quickly going through Indonesia, and I'll just talk a little bit and build on to what Raj was saying. Our priority is to get to a position where we are not losing cash in Indonesia. As far as what we believe, what we've done is that we've rationalized the portfolio. We've done to 149 stores. It's a portfolio which is more balanced, and based on this portfolio at the store level, we did report positive EBITDA. As far as and effectively at an IDR of 19.4 million for the quarter. It is showing 5.4% negative SSG, and we believe that as we continue to pursue the brand from the perspective of sales side, as we continue to remain focused on our product delivery, we should be able to bridge the gap as we and go and improve over it as we have seen in early part of the year last year. As far as Popeyes is concerned, we are currently at 25 stores. In average daily sales of IDR 17.9 million. It looks like a drop, but that's more like 39.4 was just representing 10 stores. and it was the launch period, the quarter immediately the launch period of the brand. So really speaking, not comparable. But having said that, it's not that we feel that 17.9 is a good number. We would really want to bounce back from this number. We are currently kind of waiting for some of the headwinds to start really kind of receding, is when we will start putting money behind this brand and grow sales. At these levels, though, we must admit that we are not losing any money at Popeyes level. So we are at sustenance levels as far of ADS as far as Popeyes is concerned. Overall, our revenue in Indonesia was around 302 billion, drop of 11% YOY, largely because of store closures. And at an EBITDA level, we lost around 17.3 billion. While we are at an EBITDA level, we have a 17.3 billion. The way some of the lease constructs are built in Indonesia, actual cash outflow is almost close to 4 billion less as compared to EBITDA, because in Indonesia, the rent structures are built in such a way that a substantial part of rent gets paid in advance. So there is no cash outflow to that effect in the current financial year. So EBITDA while looks 17.3 billion negative, the actual cash is 4 billion less. We would continue to endeavor to get to break-even levels or cash neutral position as far as Indonesia is concerned as we progress further into this current financial year. So that's literally from my side on India and Indonesia financial performance. The overall performance on the consolidated standalone is already shared and available, so I'm not getting into that. I just thought I'll talk a little bit more for explaining the numbers to you. So I'll just put you to Kapil, who will take us through the marketing initiatives on the India side.
Okay, so thank you, Sumit, and good morning, everyone. Just before I start the India sort of marketing update, I'll just recap the numbers that Sumit mentioned earlier. Our growth story continues. We have year on year added 60 stores to the base, so we're now at 456 stores. We delivered an ADS of 119,000 last quarter, and this was a 3.1% same store sales growth over last year's same quarter. And as Raj mentioned, this is the 9th straight quarter of same store sales growth. With the revenue at almost 491 crores, this was a 16% improvement in revenues over the same quarter last year. And this is our highest quarterly revenue ever since we started the business. Margins improved by 110 basis points, and they now stand at 67.6% compared to same quarter last year. And restaurant EBITDA, as Sumit mentioned, is 43.5 crores, which is a 29% improvement over the same quarter last year. At a company level, with 17.5 crores of EBITDA, we are 72% better than same quarter last year. So that's been the summary of what Sumit mentioned to you in terms of our results from the India business. Right now, to talk into the marketing initiatives which sort of helped us, in some parts to deliver this number. We've continued to focus on our value strategy and offer consumers better values in the market. Our lead dining marketing program for this quarter was 2 crispy veg at ₹79 and 2 crispy chicken burgers at ₹99. Now, this is a model which has given us great results in the past and has given us good dine-in traffic growth, and it continues to be a strong platform for driving traffic into our restaurants. In addition to the 2-4 model, we continue to offer the 99 meal. The meal that we promoted all of last year is still available on the BK app, right? There are another suite of meals and add-on offers which are also available on BK app as a platform for our guests who are seeking more deals and coupons in restaurants. While these are the price-pointed offers of 2-4 and 99 meal, we also continue to offer great value on shareable meals. Given the season, we have the monsoon meal deals for 2 people available in our dine-in guests to help them share a meal with their family and friends. Now I am on slide number 17. This is about our BK Cafe concept. We have spoken about expansion. Today we stand at 352 cafes, which is almost 80% of our portfolio, and this will continue to expand as we open new stores and go back and retrofit in some of our older stores. But it's more important to now see in future, we started now trying innovation on the layer. We've added iced coffees to the menu recently, iced cappuccino, iced Americano and iced latte have been added to the menu. These will help us grow incidence of the layer. And you will see a lot more work on the cafe business in the coming 2-3 quarters to grow awareness and penetration of this category in our business. Right? During the course of the year, we also continue to innovate. Raj mentioned some of the innovations we've done last year and recent quarters. Our most recent launch, the BK Pizza Puff, is a favorite vegetarian snack. The product has done very well on blind product tests, and it was rolled out in the northern markets about 8 weeks ago. We've got very encouraging results on the product, and it's now become a part of the 2-for-X platform at 2-for-59, and you will see more on this program as we go forward in the future quarters. Now, while we continue to drive traffic to our dine-in restaurants through all these promotions on value, we now have 143 stores, and as we speak, it's grown to about 180 stores, which offers a fantastic King's Journey experience to all our guests. Now, guests are offered digital ordering through self-ordering kiosks, BK app-based ordering, or a QR code on the table which you can scan to avoid the queue at the kiosk, and then your food will be served on the table. And thanks to some fantastic execution by our digital and operations teams, 92% of dine-in sales in these 143 stores is coming from digital channels like kiosk, app, or the mobile site. And our guests are loving the new experience in our stores. On the next slide, in continuation to the point on BK app, we are now building this as a platform, and a foundation for our CRM programs in the future. The BK app has a host of dine-in offers, which help us drive acquisition, and we've seen our installs grow by 70% over Q1 of last year. Even app usership has grown by about 2.7 times over Q1 of last year. And this work on the app will go a long way in establishing strong loyalty with our BK fans. Last but not the least, we continue to be one of the most engaging brands on social media with a focus on youthful and very authentic conversation with our fans. So that's it from my side. I will now hand over to Sandeep to share the Indonesia update.
Thank you, Kapil, and it is always inspiring to see some of the fantastic work India is doing, and it definitely helps us, pick up some of the best practices for our business here. Good morning to all of you. You heard both from Raj as well as Sumit that the environment here continues to be a little challenging due to the geopolitical crisis. After a long spell of 4 or 5 months since October, the business really started to get better. Towards the Lebaran festive month, which is around April and subsequently till end of May, things got better and we reached almost the pre-crisis level sales. But unfortunately, as Raj mentioned, the last week of May is when the second crisis hit us and we got adversely impacted once again. However, we continue to stay focused on doing things which are in our control. So the next few minutes, I'm going to double click on some of the stuff which Raj mentioned earlier. The first 6 months of FY24, we did a great job on the basis of all the foundation work and delivered more than 11% growth in those 6 months compared to the previous year. Despite all the challenges we have been facing since October, we still delivered a similar sales this quarter compared to Q1 of last year. We did experience a 15% drop in dine-in sales, but we successfully pivoted our strategy towards delivery and delivered a 19% growth in that channel. This, kind of gives us a confidence that guests do continue to love our brand because of the great taste experience, because of the consistent product quality, and a very strong value proposition which they enjoy from our brand. I'm moving to the next slide where I'll be talking about the key priorities for the Burger King brand, which is chicken, burger, and winning dessert menu. In the last few quarter calls, I've been speaking about the fact that Indonesia is an extremely strong fried chicken market. And having a comprehensive portfolio in this category is going to be a competitive edge. We have 2 winning products in our menu, the crispy chicken and the dunk spicy saucy version of another fried chicken. However, we also understand that there's a massive demand for a breaded version of spicy chicken. So we developed that winning product as well, did an extensive test market for almost a couple of months, and we are extremely satisfied with the result and now decided to launch it across the country in the next 2 weeks' time. In the last 3.5 quarters, our volume of chicken grew by almost 50%. And now, after having the widest range of fried chicken in the entire QSR space, we are quite confident of taking our chicken share even further up. The second strategic priority is to establish leadership in burgers. And that we'll continue to do through Whopper trials and continue to do through providing taste supremacy. We developed the Whopper based on local taste preference and then offered that product to customers at a very aggressive price of 17,000, which is almost a 50% discounted from the original price. But that has really helped us driving trials, driving frequency, and also building the Whopper equity. We are witnessing a sustained volume of 35% over the last 4 quarters. However, the work really doesn't end here. We are further improving the quality and taste of this product. We have developed a better, buttery, softer bun. Also made the patty even more juicier. We are now setting up the back end of the supply chain so that we should be able to launch this new Whopper and scale it up across the country by the last quarter of this year. Cold dessert is a massive market and we have a big opportunity to gain share in this category. And as a part of our dessert strategy, which is the third growth pillar, we continue to drive new and innovation around dessert category, either through co-branded desserts or through products which are inspired by local favorites, right? And then, in the last 1 year, we have witnessed a volume growth of almost about 2.5 times in the last 1 year, but our ambition is to double it. Most importantly, traffic continues to be our number one priority, and hence we will always maintain our value leadership position, whether we provide extremely strong value propositions through a permanent value layer, through our dining business, or very attractive entry price value layer, both for a la carte as well as combos for our delivery channel. And now I'm on the last slide, which is slide 25. Popeyes is a new brand. We have 25 stores. So the priorities are very clear at this moment. Build the product and the brand awareness, generate trials, and then continue to provide a guest a digital-first experience. We are basically a culinary brand, not only got winning products with regard to taste, but also got enormous amount of variety to address different occasions. Our ambition is to build this brand into a chicken destination. By the way, we are the only QSR chain, be it local or international, who got chicken in both fried as well as grilled formats. Grilled chicken is our unique differentiator, and it kind of contributes almost 1/3 of the total bone-in chicken volume. And going forward, we are strengthening this portfolio by adding more varieties like grilled wings, grilled sandwiches to our signature grilled collections. And this, we strongly believe, is going to be our competitive edge. We also developed a breaded spicy version, which has performed extremely well in the consumer research, and we plan to roll it out in the third quarter of this year. So now we have winning products, and the task at hand is to build awareness. In all our stores, we have digital menu board, which we are using as an ad board to create awareness and educate our guests. We also have video walls in every store which runs brand videos. In fact, we have also started to participate in some key strategic events, which also helps us in generating trials and generating brand awareness. So we have implemented our menu pricing strategy also, which will help us build the value propositions and thereby help us drive trials. We have also strengthened the digital first experience. We launched our Popeyes app last month. And, I'm also happy to report that 95% of our dining transactions are through self-ordering kiosks. So this will definitely help us build a very strong CRM program in future. And last but not the least, we will continue to provide elevated guest experience through 100% table service. So that's all from the Indonesia side, and I hand it back to Sumit to share the overall outlook.
Thank you, Sandeep. So I'll just quickly share the outlook where as far as restaurant count is concerned, we are currently at 456. We endeavor to get to 510 by end of the financial year, and our target for 700 stores by 27 still continues. As far as gross profit is concerned, we were at 67.6%, as I mentioned during my earlier conversation. Our target to get to 69% by 27. We firmly believe that we are on track to get to 69%. Indonesia, our immediate priority is to achieve cash break-even at the country level, which is what we would endeavor to get to towards if we get to the later part of the financial year. So with that, I would open up for Q&A. Please.
Thank you. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Dheeraj Mistry from Antique. Please go ahead.
Yeah, thank you, and congratulations on very good set of number of the positive SSG and improvement in profitability. So my first question, what I understand is that you have taken some price hike in online channel. Can you split your current quarter performance between price increase and volume increase?
So Dheeraj, as far as current quarter is concerned, the entire growth is literally come through the traffic growth. As Raj initially mentioned as well, that our focus is value-led strategy. We will continue to remain focused on that side. So as far as dine-in part of the business is concerned, it is led by traffic. Even on the delivery side, the growth is a combination of traffic as well as average check. But average check is something which is more trying to get customers to buy more on the platform. As we go along, we will see some correction of the pricing side, and Kapil did mention about it, that we are kind of trying to pivot our menu slightly differently on the delivery side. So we will see some price corrections going forward. We've really not seen the impact of that fully as far as the current quarter is concerned. So current quarter, the growth is traffic-led, and that is how our overall strategy going forward will also continue to be.
Got it. And second, one of the points you highlighted that the going ahead improvement of profitability would be also led by the improvement in profitability for your online channel. So can you help us with what would be the current profitability difference between online and offline channel for you?
So Dheeraj, we would really not be able to share the exact details of how the profitability is concerned. But as I was saying earlier as well, our endeavor to improve the overall profitability will be led over two levers, I would say. One is reposition our delivery on the pricing side. That's one. The second is that with the launch of new categories that we've done, cafe on one side that we've done over the last 2 years, and then the snacking product, we will also endeavor to improve overall attachment to these new categories. So that's how we're really kind of going to overall address the profitability part of the delivery channel as we go along into later part of the year.
Got it. And so second question is on, can you highlight how's the demand in India from the month-on-month perspective, whether that has been improving for you? Let's say for the quarter you have witnessed 119,000 of average daily sales. How that has been performed on a month-on-month basis?
Dheeraj, this is Raj. Thank you, first of all, joining this call this morning, and thank you for your questions as well. Dheeraj, we think that there's going to be a strong recovery in the second half of the year. I think that's what's visible to us. But for a brand that's been positive in traffic for the last 9 quarters, if you look at the industry, probably at about -4, -5, somewhere there, and we had +3. So if all things being even, we would have probably been +7% had the market demand been a little stronger. But I think as we look into the future, we expect that this will have a stronger second half performance, and we should be able to get a higher traffic increase as well as our SSSG. But we kind of stay put, awaiting that positive trend to come in. It's been a tough, this last quarter in terms of battling it out, and very good, strong value strategy is the way, and not only just value strategy, but the innovation that was put in place, with cafe that was introduced, puff that came in, nuggets that came in, wraps that came in. There's a lot of work that we have done. And we think that the next 2-3 years, you will find growth in RBA and Burger King India specifically through these, items that Kapil has put in place. All these instruments are, going to give growth in day parts as well in traffic occasions. And this company will continue to grow on this basis of traffic. As I've always said, we are traffic-led kind of company, and we will continue to drive more people into our restaurants. Thank you for your time.
Got it. We appreciate a lot in terms of your performance. compared to other peers? And sir, last question, if I may, that what would be the contribution of BK Cafe in our existing BK Cafe stores? That's it from my end. Thank you.
Yeah, Dheeraj, again, thank you for your question. We have said this in the past, that in spite of adding, almost doubling the number of cafes in the last, few months, we have got now 370 odd cafes. I mean, that's a lot of cafes that we have put in a span of very few months. In spite of that, we have maintained, average daily sales on cafe. We think that this average daily sales of between 15,000 will more than double. And that's our aspiration as we go into the future years. Beyond that, we don't share any specific information on that. But I think that should give you pretty much what you were looking for. Yeah.
Thank you.
Thank you. The next question is from the line of Mayur Gatani from OHM Portfolio Equity Research Private Limited. Please go ahead.
Thank you for the question. Just wanted to understand or get clarity is that you are saying that delivery margins will come in line with your dine-in margins. And two reasons you're saying is the traffic growth and correction in prices. Is that understanding clear?
So just correction in pricing, yes, Mayur, you are right. The second one is we will work towards improving the attachment to the invoices using the new category launches that we've recently done, which would cover cafe and some of the snacking range, puff and the chicken nuggets. So that's literally how we are going to address improving the overall profitability of the delivery side of the business, Mayur.
Yeah. I mean, Mayur, if you look at the broader part of your question, which is, we build a brand through growth, by footprints all across 107 cities and so forth. We build the cafes, we build the product line, all that stuff. Right now, it is, since we are now working on the volume through traffic, we are also, getting prepared and, the economics of the restaurant, fine-tuning those. It's on the dine-in side or the delivery side, both are in game, right? We want to make sure that as much efficiency is bought. And if you look at our P&L, and you're all aware of all the P&Ls out in the market, if you look at our P&L, we run a tight ship. We already run very good gross margins. Our line items below that gross margin are all very tight. And as volumes increases, those percentages will all become very positive. But we want to make it still more efficient. And, we are going to take a little bit pricing over the course of the next 3 quarters. And that will be evident for you. And it's the same for delivery business as well. We want to make sure that the delivery flow through coming into the business continues to grow. And you will see those in the coming P&Ls.
Okay. And coming to the Indonesia part, do we see more rationalization on the BK stores in there? Or, at 149, we are kind of stable there?
Yeah, I think we have cleaned up. We have rationalized the whole portfolio. We are there now, and we are now, just kind of, growing these restaurants. Like I said initially, we have a very strong team now. It took us a year and a half to build that very strong team. We've got all the right people in place over there. We have got a clean asset. We have closed down restaurants that didn't make any sense for us. We have cleaned that portfolio down. We have cleaned the menu, and we have got everything in place now. And if the market, even turns a little bit to our favor with all this geopolitical behind us, which I think is going to be post-October, is what the industry over there is kind of contemplating. Then what will happen is you will find this business go back to its green days when, it used to deliver significant restaurant level profitability. We'll get back to that. So we just kind of prepared We've got a good asset, we've got a good team, we have got a good product line, and we are just waiting, and we are putting things in place, instruments in place, our marketing, our delivery business. You've seen there was non-existent of delivery business. Now we've grown it significantly over there, to multiple double-digit growth. So we have put everything in place, and as things come our way, we will make that business profitable. Not only just make it positive, but make it significantly profitable. And that's the whole plan. When we took this over, we knew that this is where we are going to take the business.
Great, sir. Thank you, and all the very best.
Thank you.
Thank you. A reminder to all participants, please restrict yourself to one question. The next question is from the line of Shirish Pradeshi from Centrum Broking. Please go ahead.
Yeah, hi Rajiv. Good morning. Thanks for the opportunity. Starting with slide 10, what I observe that in this quarter, despite the heat wave, our delivery mix has come down from 45% to 42%.
Sorry to interrupt, sir. Could you come a bit close to the mic? You sound a bit distant.
Yeah, am I audible now?
Yes, sir.
Yeah. So on slide 10, when I observe the delivery mix, which used to be about 45, which has come down to 42, I assume that should have gone up given the heat wave. Now, the question which is coming to my mind is that we have done the dine-in menu changes, which is 2 for 59 and 2 for 99 in the chicken. Is that the permanent offer which is driving our dine-in mix, and is the thing which is going to be permanent SKU? And why I'm asking this, because you have built on a lot of questions around traffic. So can you share, if I take 1 year back, what is the 356 stores, the traffic growth we would have got?
Yeah, very good question. Let me try to answer this for you. You're right. Our traffic mix, our total percentage of delivery sales was 42%. See, our promotion, which is a national-wide promotion, which Burger King and RBA here in India is able to do because we own the brand everywhere. That national promotion was in dine-in, right? It was 2 for 79 and 2 for 99 in dine-in. So this is not available on delivery. So it drove a lot more people into our restaurants in this quarter, to give us that boom in sales in dine-in. Now, your question about whether this is permanent, see, value strategy is permanent. We will always be driving, traffic through a good value proposition. It used to be 2 for 50 in the past. It was a 99 rupees meal in the past. It was a 50 rupees stunner menu in the past where we had, 5 items at 50 rupees. So different things that we put in place from year to year, quarter to quarter, that couple, likes to drive traffic. But also on the other side, we have built in a lot of, for example, our King's Collection. Those 4 burgers are very, very well liked, and they grow. They continue to grow along with the Whopper burger with 7 layers on it, right? So we have a very stunning, premium menu as well. So when you drive traffic in, you don't have all that traffic end up buying the traffic menu that you put in, or the value menu that you put in. Some of them, migrate and buy other items on the menu, and that's what we're seeing as we continue to do that. So, yeah, the value menu, the value platform will be live. What we will sell on the value platform, we will, change that from time to time, and you'll see that as we evolve. Coming down to your question on profitability, look here, we want all the channels to be significantly profitable than where they are today. And we will continue to endeavor to do that. There are a lot of levers there. It's not that we are kind of looking for something in the haystack. We know those levers, and we are using those levers. We are balancing our focus on value and traffic with our check and profitability. So that's a big balance that we do every month, and we make sure that we are balancing that act as we move the business forward.
That's really helpful. Just quick last question you can answer over the course of time. In the Indonesia business, we said that cash break even at the country level. At what same store sales growth this is possible?
Shirish, I'll just kind of answer. The way we look at it is that once we start reaching the levels of sales of closer to after the portfolio rationalization, reaching an overall sales closer to around 20 to 20.5 million is where we should start seeing the cash break-even. So currently we are off by around 2 million IDR in terms of local Indonesian currency level. So that's what we are currently working towards as a team. We've taken all the necessary steps from the perspective of rationalizing the overall portfolio by shutting down stores, to even substantially reducing the corporate G&A from the exit levels that we had last year. So we've taken all those steps, now working towards improving the overall sales, which hopefully as things settle down and we see that the effect of the geopolitical issue really kind of starts to impact less as we go along, we should be able to go back and see that kind of sales. And we've seen the sales last year. If you look at last quarter one, quarter two, we've already seen that kind of improvement that we've done using the portfolio. So we believe it's a question of bringing the portfolio back to where it was towards quarter one, quarter two last year. We should be able to get to cash break-even.
Thank you, Sumit, and all the best.
Thank you. The next question is from the line of Prolin Nandu from Edelweiss Public Alternatives. Please go ahead.
Yeah, hi team. Thank you for taking my question. So Raj, you started this call with, highlighting your 10-year journey, and in 10 years we have been one of the fastest when it comes to store expansion. So that in a way comes with a slightly cost disadvantage, so to say, in terms of lease and all. And then we are also focused on value offering. You mentioned that, in this quarter, gross margin was flat because we wanted to drive more traffic, right? So my question is that now that inflation is more manageable, when do we use price levers slightly more aggressively? And what will it be dependent on? Will it be dependent on macro conditions, or will it dependent on what competitors do? So where I'm coming from is that I want to understand, how is our brand perceived in the mind of the customer? When we say value, is it primarily price-driven value, or is it the quality of product that we offer at a particular price point, so that customers will not mind even if, we take a price hike, and that will not in a way affect the kind of traffic growth that we have been seeing. So yeah, slightly more granularity on how you see the use of price levers going forward.
Thank you for your question. The first comment I'll make is, it's been 10 years, but we are just getting started, to be honest with you. It is not about all that we have done, but all that we need to do and we will do over the next 10 years that I think is more stronger. It's always a balanced mix. We call it menu architecture. And we don't drive our business on one tool. It's always, a lot of people think it's binary, and they question me on the binary nature of that. It's not very binary. It's a function of a menu architecture. You drive people in with value. You promote them with a laddered menu. You have indulgent items on the other end, right? So you have so many different occasions, different tools, the cafe, the snacking occasions, the late night business, the delivery business. There are so many levers, and you don't need to binarily just say, I'm going to raise this price and that's what's going to change my business. There are so many things in a business that are variable that you can keep fine-tuning as you go forward. So I'll give you an example. As we have introduced, this value platform several years ago, we have also built a very strong, King's Collection, which is our, premium burger range, right? And we kept on strengthening. While we bought in, 2 for $79, we put in wraps on the other side. So it's a balanced way of approaching the business in long term versus doing a short term, guerrilla gimmick to drive sales in any given quarter. So you can do 9 quarters of consistent traffic growth, 9 quarters of consistent, same-store sales growth without having a strategy in place that is balanced, which continues to drive people inside, but also to prompt people going up. in era where, ADS, average daily sales of the industry is falling, we are able to maintain that ADS in spite of putting 60 restaurants since this last year, the same quarter. So, which tells you that there is a balance, there is a thought process in the strategy. And I'll tell you, whatever you will see in the future is because of this balance. It's not just because of one lever, either on the value side or one lever called cafe. It's going to be a balanced approach on how you approach this business in the long term.
No, thanks a lot, Raj, for that clarification. Let me just ask you on the similar kind of a thing where you have mentioned that, you have taken a very, detailed view of every line item in terms of cost, both at a gross margin and below the gross margin level. So in that journey, where are we? I mean, have we most of the efficiencies in terms of every line item? Is it already there in a Q1 number, or still there are a lot of levers which can, which we can probably, use going forward as well in terms of driving cost efficiency?
Yeah. Suresh, I would say that, our focus on line items is about 25-30% there. 75%, there's a lot of structural changes that we will do in terms of, how the lines, how the power is delivered, and all those things are in the works. And there's a lot of work ahead of us, and you will see those efficiencies over the next several months coming into our P&L.
Great, Raj. Thanks a lot. Sorry. No, sir, thanks a lot. That's it from my side, and we really appreciate the kind of outperformance that the company is showing, and all the best for the coming quarters.
Thank you.
Thank you. Ladies and gentlemen, that was the last call for today. We have now reached the end of the question and answer session. I would now like to hand the conference over to the management for closing comments.
Yeah. Again, thank you everyone for taking the time to join the call this morning. I want to thank our team in Indonesia that works very hard to, in this very tough environment, to deliver some magnificent, turnaround results. And the team here in India that is working, under leadership of Cicely and Kapil, doing a fantastic job moving the business in this very tough environment as well. And I'd want to thank each one of you for, cheering us on the sidelines and keeping us honest to our numbers and to our results. So we'll continue to work hard and deliver the best that we can. Thank you very much.
Thank you. On behalf of Restaurant Brands Asia, that concludes this conference. Thank you for joining us. You may now disconnect your lines.